We're going to look at Plains All-American Pipeline, and this is an oil and gas midstream company. And what I do in my videos is I run my discounted cash flow model to figure out the intrinsic value of a stock. And I also look at the financial ratios of the company and compare them to similar companies. And I do this with you throughout the entire video, so it's like we're doing it all together. Let's get started with the model. This company has a market cap of $5.7 billion. So that's the value of the company according to the stock market. And they're trading at $7.89. So one share of stock is about $8. And next we're going to pull the free cash flow. And free cash flow is how you value a company. You estimate the future free cash flows, then you discount that number back to today. And that's exactly what I'm doing in the video. We also need the net income, which is the profit and loss for a company. And that's on the income statement. And we're going to pull 4 years of that and put it into the model and let the model do the calculations. And then we're going to pull the revenue, which are the sales. And that's also on the income statement. And you also want to take a quick look at the numbers to make sure they look okay. It looks pretty good, although in 2016, they had negative free cash flow, yet positive net income. Probably because they spent a lot of money that year and they don't pass it through all onto the income statement. What they do is they depreciate the assets over time. So little by little is expensed and the rest of it sits on the balance sheet. Let's look at the capital structure of the company to figure out what discount rate to apply to the future cash flows. They pay $425 million of interest on their debt. That's on the income statement. We'll go to the balance sheet and we're going to figure out how much debt they have. Current debt of $504 million. That's debt due within 12 months. Long-term debt of $9.2 billion. That's debt due after 12 months. Interest rate on the debt is 4.4%. Interest payments are tax deductible. Let's go to the income statement to get their effective tax rate. Since the income statement uses accrual accounting, some years may not be as applicable as others. Let's look at the 2018. That seems to be more appropriate. Their income before tax was $2.4 billion, and their income tax was $198 million. That means their effective tax rate was only 8%. But the other years on the income statement are even less in taxes, so that's why I said 2018 would be the best year. So the cost of debt is 4%. Let's get the cost of equity. We need the beta, and the beta is how much the stock moves relative to the entire market. And they have a beta of 2.31. That's a really high beta. So that means the stock moves more than twice the market moves, so it's a volatile stock. So volatile stocks tend to be more risky, and you need a higher return to compensate for that risk. Let's go back to the balance sheet and get their current assets, because we need to look at the current ratio later, and we need the current assets, which are cash, accounts receivables, and inventory. We also need the current liabilities for the current ratio, and these are debts and payables that are due within 1 year. That's $5 billion. And let's pull their equity, and it's zero. They have no equity on the balance sheet. That's not a good sign. Let's get their EBIT, earnings before interest and taxes. It's called operating income on the income statement, and that's $2 billion. And we need EBIT for when we calculate the interest coverage ratio later. Let's look at the capital structure of the company. The cost of debt is 4%, and they're 100% debt. They have no equity in their capital structure. So we're going to use the 4% as the discount rate to apply to the future cash flows. So we estimated 4 years of future free cash flows, and that estimation is based off of prior financial information. We also estimated a terminal value, which is all cash flows past year 4. We discounted those numbers back to today using the weighted average cost of capital, and we get a present value of the entire company of $17 billion. We divide that by 722 million shares, and we get a calculated intrinsic stock price of $24. It's trading at $8, so it's trading at a 67% discount. So it's a strong buy according to the model. Simply Wall Street doesn't have a valuation for this company. They don't have enough data. So with volatile companies, it can be tricky to value them. Every valuation is an assumption based over the inputs, and my assumption was my model, my inputs. Let's look at the historical stock price. It looks like they were trading almost at $40 5 years ago, but it's been on a downhill slope ever since, and it's really at a low point. The oil and gas industry has been really struggling with low oil prices, so that can be a big concern and another reason why the prices keeps getting pushed down further and further. But if you feel oil prices will increase or this industry is strong, this could be a really good value stock. Let's look at the financial ratios to get more information. They have an amazing PE of 2.6. That's price of stock over earnings per share. So investors are willing to pay $2.60 for $1 of earnings. That's a really good return because that means you only have to wait 2.5 years to get your investment back. They have a 0.9 current ratio, which isn't good. They can't cover the current liabilities, and they're 100% debt. So that's a little concerning. But they can cover their interest payments almost 5 times, so that's a good sign. Interest coverage ratio is EBIT over interest expense, and their EBIT, earnings before interest and taxes, is $2 billion, and the interest expense is $200 million. So they can easily cover their interest payments. So that's really good. Their business is operating healthy enough to cover their costs and their interest payments. The best way to look at ratios is to compare them to similar companies. And I've done videos on Enbridge, which is trading on the Toronto Stock Exchange, MPLX, One Oak, and Plains. So Plains has the best PE and the best price to sales ratio of the 4 companies. So that's a great sign. We can't calculate the price to book ratio because they don't have any equity in a capital structure. They're the best in current ratio, even though they're under 1. It's just the other companies are further below 1. So all the companies are struggling to just cover their current liabilities. And current liabilities are what the company owes within the next 12 months. We can't calculate an ROE because there's no equity. They're 100% debt like MPLX, and they're the smallest company of the bunch at 5.7 billion market cap. So this could be a great value play, or it could be a bankrupt company next year. It's really hard to tell. Let me know what you think in the comments. Thanks for watching.